I've got a story for you today, and that's the story of why international investment in the warehouse property market is going to turn your world upside down. This is a story that might turn out to be a cautionary tale, and it might have a happy ending. You'll have to decide. Where do we begin with this story? Well, obviously, like all good stories, I think we have to begin with the money. The amount of capital flowing into UK warehouse property is staggering. Investment in UK industrial and logistics property reached about £6 billion in the first half of 2021. That's according to research from Knight Frank. That's easily more than double the 2.7 billion recorded in the first half of last year. Now, of course, the first half of last year was a little bit crazy and we shouldn't really compare. But the fact is, it's also a great deal higher than that recorded in the first half of 2018. In fact, it's 54% higher than the first half of 2018. Overseas investors account for between 40 and 45% of that. Now, this is largely because institutional investors are looking for a home for their money. Why are they looking for a home for their money? There's a series of structural factors which are sending resources into warehouse property. The first is that the super rich are super richer than they ever were. Family offices, the shady would be the wrong word, but the very discreet and private operations that funnel wealth from high net worth individuals into various forms of investment. Family offices are thought to manage somewhere $4, $5, $6 trillion worth of funds. That's looking for a home. It's looking for a home because quantitative easing has pumped an awful lot of money into the economy over the last approaching 15 years, and that has to find somewhere to go. Interest rates are very low. Yields on government gilts are very, very low, negative. They're looking for somewhere that'll earn money. Logistics property, warehouses, promises much better yields than they can get elsewhere. So you might get the tiniest fraction of a percent on most investments. But the yield on industrial property is 4%, 3% perhaps if it's very keen. It looks very good to them. So they're moving, money's moving into this sector, and it knows that it will do well in logistics property because the take up, the amount of warehouse space that's being occupied by people like you is growing extraordinarily fast. Again, Knight Frank data suggests that in the first half of 2021, the total amount of warehouse floor space in mid to large box units was about 31 million square feet. That's double the amount recorded in the first half of 2020. Demand is particularly strong and supply is particularly weak for big boxes over 350,000 square feet. The upside of all of this for those of you in the logistics sector is that you get the warehousing you need fast. You get it at a price, of course, but you need what you get what you want. And the property industry is able to deliver a high quality product at considerable speed. Just this morning, we had another announcement. Panattoni, who are enormous pan-European developers, have acquired a site in Crawley, a 10-acre site. They're going to build about 200,000 square feet of last mile logistics. This is space that they do not intend to sit on. Planning application will be in by the end of the year. Work on site will begin the first half of 2022. The warehouses will be ready to occupy by 2023. This is not money sitting on land, land banking. It's determined to deliver floor space. So this is all positive, isn't it? This is all plus. But let's give it a bit of a wider picture here. Investors are going into warehousing because the thing they used to put all their money into, retail, has fallen through the floor. We all know why. And indeed, the logistics sector has been the principal beneficiary of that collapse of traditional retailing, traditional high street retailing. Investors have decided that there are two solid bets to replace retail. One is logistics, sheds. The other is rental property of various kinds, rental homes, beds. So they've adopted a beds and sheds strategy, and you can see money funneling into each of those. Just for your reference, the build to rent sector in the UK, very small but growing very fast, got £2.35 billion worth of money in the first half of this year. Compare that with the funds going into the very well established logistics sector. And you can see, whilst it's smaller, this is a very large sum of money going into effectively a novelty investment. Now, it's at this point that my story of international money begins to turn into a cautionary tale. So let's go back a little. In the 1960s, clever people spotted an opportunity to acquire backlots in town and city centres. And it is from those backlots that the Arndales, the shopping centres of the last 40 years were created. They were the last word in safe property assets in the 1970s, 80s, and 90s. That's where money wanted to be. It was the proverbially defensive place to put your resources, almost as solid as gilts. They were kind of a security. Shopping centre landlords were the kings of real estate investment, and shopping centres were their castles. Now, we know what happened next. Retail fell to bits for all kinds of reasons we've all heard far too much about. One of the consequences of that is that the owners of shopping centres suddenly find that their assets are dwindling in value at an astonishing rate. Into, who went pop last year, they owned an array of nationally known, largely out-of-town shopping centres. Their asset values, the value of their shopping centres, slid from £9 billion 18 months ago through 6 to 4 to 2 to they went pop. And they went pop because the value of the retailers' leases, the people who occupied those shops, had gone downhill rapidly as well. This is where this becomes a problem, or at least a warning, for the logistics sector. Because what caused the smash up in shopping centre values was a smash up in retail rents. The rents no longer matched the size of the turnover, the size of the potential profits of the retail tenants. And you look at the long list of retail collapses over the last 3 or 4 years, from Debenhams through to Topshop and the rest. They were all hinged on company voluntary arrangements, CVAs, which were attempts to reduce the value of rents. Rents that had been taken on in the good days began to feel burdensome. In fact, they largely killed retail tenancies. In some cases, it was a combination of super high rents, but also super long leases. Debenhams was notoriously profligate, I suppose is the word, in the way it signed leases. Makes me think a little of Amazon. Maybe that's very unfair, but they signed some very long leases. 65 years. That's a long time for a lease. Normal then would be 25 or 30. I don't think anybody would sign for anything like that long today. So when the hard times hit, as they did for retail, the huge property commitments that the tenants have made began to weigh them down. I think there's a lesson here, because without those huge property commitments, many of these businesses may have survived. The property that had helped them grow, I mean, Topshop, Debenhams grew. They grew on the back of massive shopping centre developments. The property that helped those businesses grow, in the end, sunk them. So, where's the lesson there for logistics? Now, your warehouse, your business, is flavour of the month. It is the default, one of the default options for property investment from a range of national and international investors. It's a bit like the shopping centre world in the 1960s and 70s. They had a 40-year run, then things went shit. The logistics sector is at the beginning of its run. Money is still pouring in. Today, the property business and the investors that power it very much want the business of warehouse operators, online retailers, 3PLs, and they do an excellent job at providing you fairly rapidly, with the floor space that you want. And you want what they have to offer. But don't forget what happened to the retailers. They were the future once. They rode another massive wave of international property investment. And look at them today. It's a rather different story. I'm not suggesting that there's anything fundamentally rotten or wrong with the way the property industry and its various client groups interact, far from it. But I do think that there are patterns, and leases signed today in a very different market could come back to haunt occupiers in the markets of the future. Not least because, a bit like retail, the logistics business often operates on lowish margins, high volume, low margin business. A large portfolio of leasehold commitments could be damaging. Maybe this is nonsense. Maybe the worlds of retail and its rise and fall and romance with the property business are completely unlike the current rise and romance of the relationship between property and the logistics sector. But maybe there are some similarities after all. I don't think I'm suggesting that anything's going to go wrong today or next year or even the next decade. But if this is a cautionary tale, my suggestion would be watch out. Be careful what leases you sign. Be careful on the length of commitments. Remember that if the property industry is growing with you today, it will expect you to continue to pay well into the future when your business model may perhaps have modified and changed. Leases on property do not change as fast as business models. Property is a very illiquid, well, it's not illiquid, it's an immobile asset. Literally, it's solid stuff. And those commitments are very hard to shrug off. So I hope that gives you something to think about, something to dream about. But don't worry, don't have nightmares. It's just a series of conjectures.